Let's take a look at what a company could do as a point of beginning, a starting point in analyzing their market, if they had two pieces of data. If they knew what their sales were at two different price levels. If they just knew that, they knew that when their price changed from one price to the other, their sales volume changed from this quantity to that quantity. If they know that, can they make an approximation of what sort of demand they're facing out there in the market? Now this is very approximate, this is very rough, but let's illustrate the concept of what might be going on. So we've got a problem or a sample data here on the board. We've got a price of $30 at which the company sells 100 units, and then a price of $20 at which they sell 150 units. So we've got 2 points we presume to be on their demand curve. Now what's our presumption there? Our presumption is that they're located either here or here, either at point A or point B, depending on which price they charge. And our assumption is that when we look at these two things, nothing else in the market has changed. Do you remember that assumption from principles of microeconomics? Nothing else changes. All else remains constant. We called it ceteris paribus, or maybe from where you're at, ceteris paribus, but we abbreviated it C period, P period. And we say, this appears to be the demand curve for the company, ceteris paribus, if everything else is constant. Incomes, tastes and preferences, price of related goods, those sorts of things. This is our first approximation of what the company's demand curve looks like. It goes through these 2 points, and then, for simplicity's sake, we say, let's assume it's a straight line demand curve, that it has a constant slope. Now, those are not realistic assumptions. We know that there's probably not a straight line demand curve out here, and we know there's probably some fluctuation in demand based on those other variables. But holding those things constant, let's start with just these 2 points and see what we can conclude or maybe intuit or derive from this apparent demand curve. In particular, what I'm interested in is that if I know this is the demand curve, or I assume it is the demand curve, do I know the slope of this demand curve? And the slope is the change in quantity divided by the change in price. And so what do we see here? The price changed by $10. At the same time, the quantity changed by 50. And what happened? If the price fell, a negative, the quantity increased, a positive. And so we know the slope of the curve is -5. And so from any point, if we know that the slope is -5, we go from this point to this point, we can then figure out where does that demand curve, theoretically anyway, intercept the price axis. So we would want to calculate the price intercept, and by the way, should we need it, we can also calculate the quantity intercept. And so let's be very simple and very clear on how would you do that, okay? Just so you have the concept in your mind. How do we go about calculating this? What do we know from point A? We know that the quantity would have to go from 100 to 0. So the change in quantity is going to be 100. We want to know what the change in price is, and we know the slope is a -5. Okay? And in fact, the change in quantity is a negative from 100 going to 0. So when we calculate that, what do we get? Well, solving, right? The delta P equals +20. So that's the change in the price. And the price started at 30. So it's going to increase by 20, which means our intercept up here is at 50. Now think about this. If we know the intercept up here, we know the price we're talking about. Do you remember? We can then calculate at that price What is that? That is the consumer's surplus at a price of $30. Consumer's surplus. You remember that? What is consumer surplus? It reflects the total amount of money customers were willing to spend, but they didn't have to because they were all charged $50. Some of them were willing to pay a higher price. And based on the slope of the line and the intercept, we get an approximation again of how much money is floating around out there that customers were willing to spend in this business, but they didn't spend because they were all going to pay the same uniform $30 price. So, starting from these 2 points on a demand curve, doing a little extrapolation, we get a ballpark figure on the amount of money that's circulating out there that customers were willing to spend with us, but we didn't get it. And so we can start thinking about what techniques can we employ to try to garner some of that consumer surplus. Not realistic to think we're going to get it all. Okay? So when we have this sort of data, 2 points, and we make these somewhat unrealistic assumptions, we at least get a starting point on what kind of demand are we facing out there. All right? So you should be ready, if I'll give you any 2 points of data for a company, it's sales at different prices, you should be ready to extrapolate from that an approximate demand curve and, for any given price, an approximate consumer surplus. Remember, if we were down at a price of $20, what happened to the consumer surplus? Well, they got one heck of a lot bigger. Okay? That's a good starting point.